Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Now let's dive into the tech that's making property flipping faster, smarter, and more data-driven than ever. Sustainable and green renovations trends. Here is a growing demand for eco-friendly homes. Buyers are increasingly aware of their environmental footprint. They also want to save on utility bills. Incorporating sustainable materials and energy-efficient upgrades can attract this segment of buyers. Think about renovations such as energy-efficient windows and insulation. These reduce heating and cooling costs. Low-flow plumbing fixtures. They conserve water, a major selling point. Sustainable flooring options. Bamboo or recycled materials are popular choices. Solar panels. While a larger investment, they can significantly boost property value and appeal. Going green not only appeals to buyers, but some sustainable upgrades may also qualify for tax incentives or rebates. This helps offset renovation costs, making green flipping a smart financial move. Financing property flips in 2025, strategies and challenges. Securing the right financing is just as important as finding the right property. In 2025, the lending landscape might present new hurdles or opportunities. Understanding your funding options and how to meet lender expectations will keep your flipping business strong. Let's explore the various ways you can finance your next project. Hard money loans versus traditional financing in a changing market. Choosing between hard money loans and traditional bank financing depends on your project goals and timeline. Each has distinct pros and cons, especially in a dynamic market like 2025. Knowing when to use each can save you time and money. Hard money loans are short-term loans from private lenders secured by the property itself rather than your credit score. They offer fast approval and funding with flexible terms and minimal paperwork. You can close deals quickly, which is key in a competitive market. Hard money is ideal when time is critical and you need a fast closing. However, these loans carry higher interest rates and fees with repayment terms usually ranging from 6 to 18 months. They work best for projects with clear exit strategies and rapid turnarounds. Traditional bank financing comes from banks or credit unions and is based on your creditworthiness and the property's value. These loans feature lower interest rates and longer repayment periods, which can mean lower monthly payments and overall cost-effectiveness. On the downside, the application process is slower and more rigorous. Banks require extensive documentation and have strict underwriting criteria, making them less suitable for properties needing significant repairs or quick closings. Private lending and joint ventures as funding solutions. Beyond banks and hard money lenders, private capital and joint ventures provide other paths to funding. These options offer more flexibility and often build valuable partnerships, enabling you to undertake larger or multiple projects. Private lending involves borrowing from individuals or private investment groups rather than institutions. Private lenders often offer more flexible terms and faster approval. They focus on the deal's potential rather than just credit history, and successful relationships can lead to repeat funding for future projects. Terms can vary widely, so review agreements carefully. Interest rates may exceed those of traditional bank loans, and building trust with private individuals is essential. Joint ventures mean partnering with another investor or group. Your partner contributes capital, and you contribute expertise. This setup allows you to tackle larger projects without providing all the capital yourself. You share both risk and reward, and can benefit from pooled knowledge and resources. Be sure to establish clear roles, responsibilities, profit splits, and exit strategies up front to avoid misalignments. Navigating lender requirements and due diligence. Lender requirements may evolve in a changing market. Meeting those criteria is crucial for securing favorable financing. Thorough due diligence on both the property and the financing terms protects your investment. Understand that lenders in 2025 may place greater emphasis on your experience as a flipper and on the property's after-repair value. Keep your financial records organized and have a solid business plan ready. Maintain a strong credit score if using traditional loans. Prepare detailed project budgets and timelines, and outline a clear repayment strategy. Property due diligence means obtaining a professional inspection to uncover hidden issues, researching local market comparables to ensure realistic after-repair values, checking for liens or encumbrances on the title, and understanding zoning laws and permit requirements for renovations. Financing due diligence involves reading every line of your loan agreement to spot hidden fees or strict clauses, comparing multiple offers, clarifying interest rates and repayment schedules, and understanding penalty fees or extensions if the project timeline slips. Understanding local zoning laws and building codes. Before you renovate, you need to know what local zoning laws and building codes allow. Permit requirements vary by jurisdiction, and most structural or electrical work needs official approval. Starting without a permit can trigger stop work orders or fines. Zoning laws dictate property use, whether residential, commercial, or mixed use, and may limit adding extra units. Building codes ensure safety and quality from foundations to fire safety measures. Compliance saves time and money by preventing unapproved work that must be redone. Capital gains tax implications on property sales. When you sell a flipped property, capital gains taxes apply to your profit. If you hold and sell within 1 year, the gain is taxed as ordinary income. Longer holds may qualify for lower long-term rates. Your taxable gain equals the selling price minus purchase price and qualified expenses like renovation, closing costs, and commissions. Keep meticulous records to maximize deductions. Consulting a tax professional can reveal additional strategies or credits specific to property investors. Contractual agreements and due diligence best practices. Solid legal paperwork is non-negotiable for protecting your interests. Your purchase agreement should clearly outline price, payment terms, contingencies, disclosures, and closing responsibilities. State disclosure forms may require you to reveal known defects to the next buyer. Contractor agreements must specify scope of work, materials, timeline, payment schedules, lien waivers, insurance, and licensing. Always verify the property title is clear of liens or judgments. Use professional inspections to detect hidden issues and validate your renovation budget. Confirm after repair value estimates by comparing similar recent sales. Market analysis and contingency planning. Constantly monitor local home prices, days on market, and economic forecasts to steer your projects. Build contingency plans for unexpected challenges like renovation overruns or market downturns. Maintain a financial buffer of 10 to 15% over your renovation budget. Prepare alternative marketing strategies such as adjusting price or offering buyer incentives. Have backup exit strategies ready, including renting the property or pursuing lease option agreements to protect your investment. Diversification of investment approach. Diversify by investing in various property types and locations. Single-family homes appeal broadly, condos and townhouses target different buyer pools, and multifamily units can generate rental income if a flip stalls. Mix urban and suburban markets to balance demand from young professionals and families. Spread projects across emerging and established neighborhoods to reduce exposure to localized downturns. Pre-sale marketing and pricing strategies. Generate buzz early with "coming soon" listings for agents and buyers. Share renovation progress on social media to build anticipation. Leverage your local agent network to find ready buyers. Use comparative market analysis to set realistic prices. Employ pricing psychology by ending prices in nines to attract buyers. In a hot market, you might start slightly higher. In a cool market, price competitively for quick offers. Consider incentives like covering closing costs or including a home warranty to differentiate your property. Flipping property in 2025 demands a sharp focus on market trends, strategic use of technology, solid financing plans, and strict legal compliance. By staying informed and prepared, you can navigate this dynamic market and make smarter investments. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.